Anant Narayan, Co-Head Wholesale Banking South Asia with StanChart Bank, joins us live. Anant, fantastic to have you back on ET Now. Thank you for joining us. Anant, I've got two reports in my hand, one from Goldman Sachs, other one from Bank of America Merrill Lynch. And the headline from tonight's event is, according to Goldman Sachs, Fed will taper light, and Bank of America Merrill Lynch is insisting that they will not do anything to shake the apple cart. Are you in sync with them?
It's difficult to be in sync with both of them. What we believe personally is that we will see a taper of $10 billion. While the last few data points coming out from the US have not been that favorable towards growth, particularly the employment data was a little disappointing. Having said that, the overall trajectory in the US is one of recovery. Clearly, it's one of the bright spots in the global economy right now. And to that extent, it's only reasonable to expect that tapering will start and will probably eventually end sometime second half or the third quarter of next year. So we remain that with the belief that we will see a taper of about $10 billion starting today. I think what will also be very interesting to note in the statement, besides the taper or the verdict on the taper, is the actual language that the Fed adopts. Does it adopt a more dovish tone? Does it adopt a more neutral tone? I think the expectation, at least that we have, is it will be a little more dovish than the market expects, given the softness in the data points. Essentially saying that the taper is on board unless, and it will remain on board till such time that the data points support it. And if things happen to slip up again, that they would take a fresh look and maybe not be as aggressive in the unwinding as one would expect. Also, very interesting would be to see what their views on 2016 look like. Do they expect to see a lot better economy in the US in 2016? Because, if you do reach a state of maximum employment by 2016, around that time, Fed funds rate is typically in the range of 3.5% to 4%. So it sort of will give you a kind of a time frame on what to expect on the Fed fund rate as well, not just on the tapering.
So then what happens in terms of tapering happens, like you're saying, Ananta, $10 billion is what you're expecting. How would it impact global liquidity and in specific Indian markets? Do you see more capital outflows from India and an effect on the currency as well?
I think India is going to be a combination of several factors, really. Yes, Fed and tapering and what happens to global liquidity is clearly a factor. But we must remember that even with tapering, the globe is still aflush with liquidity right now. Yes, there will be a recalibration of funds moving from debt to equity to more or less risky assets as perceived by the globe. But the funds still remain in the system. As far as India is concerned, I guess the last few days and weeks have been one of relief. After seeing those really bad run of dollar rupee going up to 68.80, it's a relief to see some kind of sanity coming back into the system. It's a combination of several factors. The positives have clearly been the fact that over time trade deficit genuinely seems to be improving. Coming back from the $18-20 billion range to the $12 to $10 billion range, which is a huge positive. The second thing is the RBI has taken a slew of steps. One, it's taken out the dollar demand from the system by providing dollars in some form directly to the oil importing companies. It has also announced these measures on the FCNRB and for the banks to raise dollars and bring the dollars into the system. And there could be more on the way, which one hopes will bring in dollars into the system by way of capital flows. Thirdly, the global system, the global outlook has improved a bit as well. Syria, which was a huge problem 2 weeks back, seems to have eased off. That clearly helps in terms of oil prices and in terms of the emerging market sentiment globally. So there are a few positives which are going through. And personally, we don't expect the balance of payments this year to be as bad as one would have expected, looking at the way in which dollar rupee was moving. Having said all of that, clearly the medium-term worries remain. India remains vulnerable as far as growth is concerned. There is clearly a corporate sector, particularly the ones stuck on infrastructure investments, aren't doing too well. And that provides an kind of an overhang to the banking sector as well. That remains the single biggest problem, if you ask me. And a lot of the problems which are solvable, including, the coal imports, the iron imports, starting off the stuck infrastructure projects, unfortunately require political will and political decisions, which might ease off going into the election. So as we come closer to the end of the year, you might have concerns coming up again about what this means for, what the elections mean for the Indian economy and for capital flows into the country and the equity markets overall. So at the moment, there is a sense of relief. There is a sense that we have managed to avoid that deadly trap of a vicious cycle taking dollar rupee out in a spiral out of control. That has clearly been arrested by the RBI and by the steps taken around that. The medium-term concerns, though, remain. And it's a combination not just of what's happening on the Fed and the tapering and the global geopolitics, but also what's happening domestically and, a lot of moving parts there.
Right. That's the good news. But do you think all the bullish argument will get trumped if Fed decides that, look, we will taper more than $20 billion a month?
There will clearly be a shakeout, and no questions asked. We saw what 22nd of May did to the whole emerging markets, and particularly to India. But my own sense is if the Fed starts tapering in a big way, it just tells you that there is a lot of confidence that the US has in its own economy. And to me, in the medium to long run, and I know in the long run we could all be dead, but in the medium to long run, an economy in the US which is firing on all cylinders cannot be bad news for us. Yes, it's true that this time around the recovery in the US could mean a lot less of importing by the US, and so therefore it doesn't necessarily have to immediately translate into good news for emerging markets. But frankly, for a service industry oriented country like India, a US which is doing well in the medium to long run has to mean good things for us. And let's not forget, we now have a reasonable competitive advantage in terms of a rupee which is significantly weaker than it was 2 years ago. So if you actually have global demand going up on the back of a robust growth in the US, that has to be good for our export sector, not just in services, but also in engineering goods, in all variety of industries. So yes, if you do see a shocker coming in from the US in terms of liquidity contraction or unwinding of the easing means, it could mean a shock to the emerging markets, which could again put us into jeopardy. But personally, I think medium to long term, that's not bad news for us.
Anant, let's look back home. We've got the RBI policy as well to deal with come Friday. Do you think the high inflation figure that we've just seen gives a very limited elbow room for the central bank to cut rates in future?
Well, actually, it will be very interesting in a variety of ways watching this credit policy, because it will give us a glimpse of what Dr. Rajan's philosophy around monetary policy is. Yes, there are several moving parts on the monetary policy as well. One of the questions that we've always had is, what inflation do we look at? And it's been an age-old problem, but I think it's coming to fore again. WPI itself has been on the higher side than compared to expectations at over 6%, but that's probably a blip because of vegetable prices. On the other hand, core inflation in WPI is now below 2%, which is extremely good news. At the same time, you still have CPI, which is remaining pretty high at 9% plus. And we must remember that the RBI has announced an intention of issuing savings bonds linked to CPI. So does it mean that we start looking at CPI a lot more closely? Maybe it does. So we also have seen in the past Dr. Rajan talk about inflation targeting being the primary concern of any central bank. So it will be interesting to see what language emerges out of the policy. Personally, what we are hoping for is that some of the measures taken on 15th of July and 22nd of July, reiterated on 22nd of July, hopefully they could be eased a bit. Dollar rupee has stabilized a bit. Having, liquidity as tight as it is, having CRR at 99%, having the amount of money that you can repo and at LAF at a low ratio, maybe those can be eased up a bit without actually tinkering with the interest rates.
Right, Anant, we got to leave it there. Really appreciate your time and thank you for your insights.